All right, good morning, everybody. It is a Monday. Yeah, but right, just another manic. Anyways, it's 6:34 on Wall Street, 3 hours before the open of trading. It's time to get your global macro on a QuantBox Live, where we uncover the best fundamental investment opportunities across the globe. Yes, our AI-driven analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning, and seasonality, and so much more uncover these opportunities. Like, are you watching the VIX? Are you going to watch gold today? What about yields? What about the dollar? What about the yen? What about, like, how can I watch all of these at the same time? How can I be in 9 different places at once to see the short term and consider long-term trends in those data points? Oh, well, that's what QuantBox does. Very cool. Very cool. So, anyways, it automates your global macroeconomic research so you can make intelligent investment decisions. But more importantly, because you're making your decisions based on facts and data, when you're on a trend, you'll have the confidence to let your winners run. So, for example, maybe the S&P 500 is bearish, just maybe. Well, you can look. You don't. They're more than technicals. You can understand why. Things like seasonality, fundamental differentials. Okay. This is positioning. Yeah, this is the commitment as traders report. Yeah, positioning of institutional investors. Huh? Look at that. A little bit long oil. Yeah. So, anyways, this is really, really, really awesome stuff. The colors are pretty. So, if you're watching this on YouTube, you're watching it many hours delayed. Many, many, many. I'm delaying them even more. I think now they're delayed like 10, 12 hours. So, anyways, kick down, come clean. Don't be a holdout machine. You know you want it. It starts with an $8 trial. You should check it out. Give it a test drive. Without further ado, let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Let me log in. Mm, 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 mm. So I spent hours and hours and hours and hours. I probably spent 5 or 6 hours yesterday doing economic research at the Fed. No, I wasn't physically at the Fed. I was in my backyard on a laptop with the internet. But it's pretty cool that you can log in and do this research. And I made some changes. A bit. So I was playing around with seasonality. Oh, wrong one. Mm, mm, mm. Okay, and I made some changes. Oop, let me get. And I'm not sure if you'll like the changes, but I made the changes because I was trying to answer a question for the stock trading course. How can I teach you to know that we're in a recession before everybody else knows we're in a recession? It's a great question, isn't it? And the government will tell you in some cases, get this, 21 months after the fact, they'll tell you. So 21 months after the great financial crisis, it was confirmed we were in a recession. No joke, 21 months later. All right. So, anyways, can we speed that up a little bit? Because here's the thing, let's say on average, let's say it takes at least 6 months to tell that you're in a recession, but the market is trying to be 6 months ahead. So if you're going to be 6 months ahead, you kind of need to know that before it's declared. So, anyways, so I was answering that question, and the next lecture in the stock trading course is going to be on cycles, and so that's why I was on the Fed database manipulating their data, which is kind of fun because you can create your own charts. Um, and then I went back and I reshaped some of this seasonality. So here's week by week on average over the last 20 years what each week looks like. So kind of looks like this week 18 is a big week. Okay, interesting. But then what I did is I did it again, but a cumulative. This is the S&P 500, the shape of the S&P 500 over the last 20 years. Okay. So this is each individual week. This is each individual week building up on itself. Okay. So anyway, so you might want to play with that. And this is typically what the S&P 500 looks like, or I don't have the S&P 500 up, but okay. So I have to reshape it. All right. So this is typically what the S&P 500 looks like. And this is what's happened this year. Shows you how strange this year was. So we've given it all back, all the way back to average. Anyways. And again, I switched this compared to what it was before, cumulative. So it shows the shape of the S&P 500 throughout the year. Okay. Anyway, so I'm going to use this in the lecture. So play around with it, see if you like it better, see if it makes better sense. I'm just trying to see, it's just data. So you can twist and turn and poke and prod and display it differently. What I'm trying to do is have it have meaning, okay, and provide insight. So let's check those things out and see if they're helpful. Okay, a little bit of risk off here. Yield closed Friday 4.92. It is now at 5.01. It was 5% 17 years ago. So first time in 17 years that we've hit that mark. Well, if you think about it, you take your level of inflation and you add a couple of percent to it for investing for 10 years. If inflation is 4 and you want to get paid your risk premium or duration or term premium, if you recall, is, let's say it's 2, then 10-year T-note could go to 6 if inflation stays around 4. Okay. But at some point, I think we're going to want to buy that and hold it for 10 years. Might be interesting, huh? What I'll do is actually I'll split the difference between the 10 and the 30 and take the 20. Anywho, and for those, where did I do it? Was it in the stock trading course? I showed somewhere how unique the 20-year is and why I'd want to pick on it yield wise. I forget where I did it. Sorry. All right. So Bitcoin over 30,000. Oy vey. Look at that. Amazing. S&P 500 down, and it looks nasty. We'll take a look at that later, but it could be down until March. Probably up in December, but generally speaking, down all the way to March. Sorry. You would expect dollar to get strong, and you see QuantBox is already pointing that out. Yet it's not very strong at the moment. Yeah. Very unseasonal. So QuantBox is going to continue to tell you, because it's valuable information, many things that usually are going up, or many things that are typically going down this time of year, are going to be doing the opposite. It's not wrong. It's that's the data. So you have to interpret that if the stock market is falling in a time when it's usually rising, it shows you something is creating that unusual move. Looking further out, yeah, VIX, look at that. Very, very, very bad. Lots of volatility. That's difficulty. Again, a way to interpret the VIX, it's not really volatility. It's volatility that makes people worried. It's called the fear index. and they're worried enough to buy insurance. So what this is telling you, and this is good for all retail traders that are just trading like it's normal. This shows you that all institutional investors that have already built and constructed a portfolio of stocks are hedging. They're actually doing something. It's not an opinion poll. This is money flowing into the options, right? Into the options market to protect cash positions in the stock market. So a retail trader just stands there and does nothing. Okay. So is this fear? Yeah, but it's also action. It's not panic like people are dumping their stocks. They're actually buying insurance to maintain their stock position and make money on the way down to offset the cash losses. The derivative makes money on the short run, and then the money it makes, they take and they plow it back, buying the stock market back. So, like, for example, I just said I think the stock market could fall all the way to March. So, if you can make money using options as a hedge, and this is what VIX is measuring, between now and March, you take all that money, and March, let's say, is the low, and then you buy the S&P 500 back cheap. And you, okay, lower your cost basis. Nice, right? That's what they're actually doing. Okay. Okay. And yeah. So it's called the fear index. I think it's more like, do what you got to do index. You don't want to pay for insurance if you don't think it's going to fall. Well, they're paying for insurance. So, anyways, valuable information to know this. Okay. S&P 500 is down. That makes sense. That's why they're hedging. Okay. Gold is up. Okay. That's good, especially if you believe inflation. So remember when we were going from 9% to 8% to 7% to 6% to 5%, 4% inflation, I was a bear on gold. And then one day we got to a point where inflation stopped falling. And I'm like, now's the time to be a bull again. In particular, inflation is higher than growth. See, if GDP was higher than inflation, I wouldn't care. I'd sell gold. But inflation is now stable and stable above GDP. And on top of that, GDP is probably going to fall. So what was that, 3-4 months ago? I'm like, that's when you buy gold. Gold went from 18, now we're all the way to 2000. That makes sense. That's logical and normal. Okay, yen is a bit weak over the month. Okay, and that's unusual for bearishness. Okay, yields are up on the 10-year, very bearish. Remember, if yields are up, nobody's buying the bond market. Bonds are falling. Okay. I interpret this as it's the government's fault. I think this is the government's fault. And there was another spike, right, recently. And that spike has to do with, we're going to get involved with yet another war. Okay. So whether you agree with the war or not agree with the war, let's just say the United States supports the war, like we do with the Ukraine. How many billions of dollars have we spent in the Ukraine? 100, 200? How much are we going to spend in the Middle East? 200, 300, 400 billion? Okay, where's the money coming from? The budget? No, because you created a budget last year before the war. So if you just spend because you need it, that's not a budget. Okay, that's not a budget. Our rainy day fund? There's no rainy day fund. Our savings? What, America doesn't have savings. The government runs a deficit. Even on a good day with peace and prosperity, there ain't no money. So if you're going to come up with a couple of extra 100 billion here and a couple of 100 billion there, you sell treasuries. And the way we see it as market participants is higher yields. So you send money, the government sends bombs to the Ukraine, You pay higher interest rates on your mortgage. You pay higher interest rates on your credit card. You pay higher interest on your car loan. Okay. So, anyways, that's what's happening here. So, the 10-year T note today has crossed um, in overnight markets. It now has crossed 5.0. Yep. And you're like, Wayne, I don't get yields and stuff. Why is that meaningful? Well, maybe you get this. 2 years ago, it was less than 1%. So let's call it 1%. Then it doubled to 2%. Then it doubled to 3% and doubled to 4% and doubled to 5%, right? Each 1% increase being double the 1%, not 1, 2, 4, 8. No, it's 1 plus 1 plus, it's up 500. Interest rates in the United States are up 500% in 2 years. Yeah, does that matter? You're like, I don't know nothing about that, but that seems to be important, right? Yeah. Imagine your mortgage doubled and then doubled and then doubled and doubled and doubled. Well, that'd be bad, right? Yeah. So, anyways, so lots of risk. And again, what does QuantBox say? Watch dollar, watch yen, watch Swissy. Dollar hasn't moved. Yen is already being manipulated by its central bank. So that's confusing. So the cleanest trade right now is Swiss franc. Okay. So we can look at the historic data and do a cross like Aussie Swiss franc. Okay. And technically it's down. QuantBox is projecting this dropping all the way down to 55, best case scenario, if you're a bear. It's neutral because we're not quite there yet under normal conditions. See, it helps you separate reality, which is the technical analysis is reality, and the fundamentals are normality. Both are important in your analysis. What is happening versus what should be happening. And if there's a difference, oh my God, you got to be able to see. Okay. And in this case, retail sentiment is 85% long. Gee whiz, huh? Can't fall further, right? Well, that's an amateur mistake, isn't it? Oh, it can't fall further. Yes, it can. Yep. Yes, it can. Normally, this time of year it goes up. See, seasonality gets a positive score. Yeah, well, that's too bad. So sad. Normally, it's up. We don't normally have two wars. Okay, we don't normally have two wars while the United States is supporting the wars. We don't normally have two wars while the United States is supporting the two wars while the central bank is trying to create a recession. Instead of spending the money at home, we're spending it abroad. We should be building pipelines. Why? Because we're supporting two wars with money we don't have during a time where we're likely to go into recession, and we don't have any oil. We don't have any in strategic reserves. We don't have any in industrial reserves. We don't have any oil. One hurricane, one terrorist attack, one pipeline gone somewhere, and you don't have any gasoline to go to work tomorrow. You understand the possibility that there could just be no gasoline 3 months from now? You want to go to drive to grandma's house for Christmas and there's no gasoline. There's giant lines at the pump. It's $7 a gallon, and there's none anyways. I was just in Cuba and I saw lines just like that. Men standing in line, hundreds of cars, not hundreds, dozens of cars with men standing there, and that was their plan for the day. Get in line, wait. That was the plan. And if gas shows up, they might get some. Meanwhile, the women were standing in line at the ATMs, waiting to get cash out. because their cash is trash. So you got to get it out of the bank as soon as you can get it. So then the government put capital controls that you can only take out basically $20 a day. So women stood in line for hours and hours and hours and hours to get their $20. Because if you didn't get it out now, next week your $20 is worth $10. So you better get it out now. So are we heading there? Well, you know what? I don't know about bank runs like that, but I saw what happens when there's scarcity. People forget. Go back to the 70s when we had oil shortages and war in the Middle East against Israel. You're like, wait, it's exactly the same. But we forget our history, huh? So, anyways, yeah, terrible. So, in a scenario like that, you want to think about Swiss franc. And that's unusual. This is not usual. This is not business as usual. I pointed that out immediately 2 weeks ago when, right after the Hamas, right? That's that Monday after the Hamas attack. I'm like, this is what you do. Don't turn your back on Swiss franc. Okay. And apparently retail doesn't understand that. So, anywho, we can look at it in the real world. And, yep, we can go to a smaller time frame. Here's your Aussie Swiss franc. Down, 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 up, up, sell, down, 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 down. And now we are hitting a logical target. And typically I would look to take profit here, but I don't believe this is typical. A retail trader might long this because we're at the M1. And I think of much of the world simply moving their money out of their country, not particularly Australia, but it doesn't matter. I'm not really selling the Aussie. I'm buying the Swiss franc. This was just my example. And I think money flowing to Switzerland has nothing to do with this chart. I think when there's fear, you're just moving your money. You don't even know what the price is. What's the price? You didn't even ask. What's the value of the Swissy these days? Doesn't matter. Get your money out. Okay. In this case, your money might be leaving the Middle East and going to Switzerland. So this is definitely a take profit area. This is definitely a taking profit area. And I might have to ignore all of that because I don't believe what's happening is necessarily rational. So this will be a big test. As you see, I made a big stink to show you to get ready for that pullback. It looks like it was the right thing to do. And now it's time to make another big stink. You know, that we're definitely at a place where if it was going to go back up, it would do it now. That would be rational for a reversal. The thing is, I'm not even going to think about it. You're being rational at a time when the market is emotional. Okay. That's not the reality, I believe. The reality is, if you watch the early days of Mike Tyson fights, you can see the other boxer. He comes out, he's been training. He's like, yeah, I got this guy. I've been training. I got a strategy. And then 3, 2, 1, Mike Tyson is just like a wild animal, just viciously and uncontrollably attacking. And you're like, what's this guy doing? And all of a sudden, the guy's surprised. And then he gets hit in the stomach. Yeah. Rationality, when Mike Tyson hits you in the stomach, 4 seconds into the first round, you become emotional. Can you imagine that? You're like, yeah, I'm going to jab for the first 3 rounds. And I'm going to tire him out. Oh my God, he just hit me in the stomach. Right? Yeah. Have you seen those old You got to look at YouTube. I haven't seen them in a while, but they're amazing because Mike Tyson's thing was he'd hit you with his left in the stomach. He did do it about 3 times, and all of a sudden you see the guy, like, his ribs are breaking, and then with the same left arm, so you get this bang, 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 and then a left hook to the chin because 'cause you're crunched over because your ribs are breaking, and all of a sudden he breaks your neck, and then you're like, "Oh, dang it, it's 12 seconds into the first round, and, 4 ribs are broken, and he snapped your neck." Yeah, good night. But somewhere in there, the logic went away of that fighter. Then he got emotional, like, ow. Yeah. And then sleepy time. So we're in that period where this is a shock to the market. And these are the best times of the year. I was waiting for October. And this is my worst case scenario. So what? Adjust. Okay. Which one are you? Are you Tyson? Yeah. So don't let this be sleepy time. All right. So, anyways, so Aussie came down, but notice that Aussie's actually doing okay right now, huh? Depending on what you're looking at. So the better trade here, this is Aussie Kiwi, the better trade in the risk off scenario is actually the Kiwi. And I'm the most bearish on Kiwi. And look at that move. Kiwi Swissy. Holy smokes. Beautifully set up, though. Thank you, Wayne. Okay. I'll do it in a slightly different color. Okay. That had to do with the previous top to the left. Okay. You see it's all marked out. Down, 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 up, up. Okay. Amazing, right? You know what this is? The gap on Monday after the attack on Israel. I said, do not turn your back on Swiss franc. I pushed it hard. I said, gold's going to go up, oil's going to go up, Swiss franc's going to go up. Pick your poison. So, anyways, this isn't to say, ha ha, I told you so. It's more like I'm trying to reaffirm the lesson that, like I said, don't be logical, be emotional, freak out. This is real fear. Big things could happen. I was giving analogies. I said, think of people of private jets flying into Zurich. You guys remember this? And the door opens up and 5 men come out carrying Louis Vuitton bags full of cash. And they're going straight to the Swiss bank. I try to paint these pictures so that you can remember them. Not just bags, but Louis Vuitton bags. Not just guys, 5 men. Private jet, Zurich. I think I even made a joke about the banker. But nonetheless, I want you to know that in times of duress, in particular exogenous shocks, or otherwise known as black swan of type events, this is what your contingency plan should be. Know to go to the Swiss franc. And now I'm just reaffirming, like, that wasn't bad advice. So now you've written it down. Okay. Anyways, so Swissy strong versus Aussie, Swissy strong versus Kiwi. I think another one I pointed out was the pound. Pound Swissy, I lovingly refer to it as pissy, is actually a great currency pair to trade. But it seems to me this pair was in a range. Okay. And this is the Monday after the attack. It dropped so much I can barely fit it on the chart. But yes, it was a down followed by an up, followed by a down, followed by an up, followed by a down, followed by an up, followed by a down, followed by an up, followed by a down. Notice we're still respecting proper price levels. And I don't know, what do you think? Okay. So it's going to be an interesting week. Fundamentally, there's another level that's not seen on the charts right now. So I guess you can call it fundamental. It's not really fundamental, but this is an important week during earnings season. And Alphabet, can I just call it Google? Google and Meta. Can I just call it Facebook? Google and Facebook and Amazon and Microsoft and UPS. There's some big household names. Intel, okay, are reporting. They're big names, they're important names. If Imagine if they all just came out awesome. And I think so because I've analyzed GDP. I think they did great. Um, so all of a sudden we could have risk on again and everything's cured. And then the ground war starts next week and then we give it all back. So be careful, right? It's hard to make these calls. It's an emotional market. There's a lot of fear. We're probably in recession. I can't prove it to you now, but in 2 weeks in the stock trading course, I will tell you how to know before everybody else. Okay. It's cool, man. Like I'm telling you, it's cool. Um, but all data is lagging. So I suspect we are now, as of 2 weeks ago, in recession. But it's not suspect that makes you make rational decisions. So what else? What I can show you is you could prove it before everybody else, but it'll already be late. But you'll be 6 months ahead of everybody else. Okay. And what I'm going to also try to show you is most of the things you believe are true that you've been taught, all these rules of thumb, are either not quite accurate or just flat out wrong. But I'll also show you um, we want to be one of the earlier investors back into the market. If the market's going to come down, like the S&P 500, I'm going to try to show you how we can be one of the first ones back in. So we want to be one of the first ones to hedge. We've already seen institutionals hedging, and we also want to be one of the first ones back in, and we don't miss the rally back up. Because by the time you are told it's safe to go out again, and it'll be over. So anyways, we got to be you know, one of the sharper tools in the shed. How about that? So I'll show you how. With that, I wish you a great week. It's going to be probably choppy. And because of lots of good news and lots of bad news. Yeah. So peace on earth. May the pips be with you. May our profits be above average. I'm sure I'll see you around shortly. Cheers.